Welcome, everyone. My name is Michael Evans from Cogent Strategic Wealth. Welcome to the Clarity Throughout the Coronavirus Chaos live stream. With all the market volatility and the chaos around the COVID outbreak, people are wondering how this volatility is going to affect them. The volatility brings with it a ton of emotion, which is understandable, but making emotional decisions with your future can have devastating effects. We want to bring some clarity to you today by explaining what is going on in the markets and give you some tips on how you can not only survive this coming recession, but also help you better understand what happens on the other side of most market corrections. I'm pleased there are a number of other wealth advisory firms on the Buckingham network with us today, including my good friend, Eric Sobocinski, and his clients. I really appreciate the network of good advisors we have that work so hard to help their clients at all times. So a little information from you. During the live stream, we'll be asking you to keep your volume muted and your video off. We are going to move to a platform soon that'll be a full webinar, but right now we're just going to ask you to do that. So if you can make, everybody's muted right now except Larry and myself, and we'll see at the end of 60 minutes how that works out for everybody. But we're just going to ask you, if you happen to unmute accidentally, whatever, that you go back and mute again. Also, there'll be some follow-up after the webinar. We're going to send out an email. You'll be able to get our 20 actions you can do right now to prepare for a recession. You'll be able to receive a copy of Larry Swedroe's book, A Successful and Secure Retirement, which I think is the manual for managing your wealth management. It's basically the process by which we take all of our Cogent clients through, and we're very happy to have Larry as an expert on our team at all times. And you'll also get an offer for a second opinion service if you're not already with one of the wealth management firms that have invited you to join today. So I'm Michael Evans, the founder of Cogent Strategic Wealth. I'm joined by my colleague, Larry Swedroe of Buckingham Strategic Wealth. Larry spends an incredible amount of his time, talent, and intellect educating investors just like you and me on the benefits of evidence-based investing as the Chief Research Officer for Buckingham. I'll give a brief description of where we're at today, and Larry will then educate us and possibly take some questions from us on what he sees today and what he knows in the data that tells us about what we can maybe expect going forward. All right. Let me go back up. There we go. As I mentioned at the beginning, with all the market volatility and chaos around the COVID outbreak, people are wondering how this volatility will affect them. Given the sheer volume of unfolding news and things coming out about the virus, it's certainly understandable if you have concerns. We too have concerns. Larry and myself and the entire Cogent team all owns portfolios that are somewhat similar to yours in so many ways, except for the amount of risk that we take for our particular situations. But we find ourselves asking, as many investors do, what's going to happen next? Where is this going to go? How is the economy going to react? And how is my family going to survive and thrive through this? It's very understandable to have these concerns, but you should know that there is an awful lot of history out there, what markets have done through other crises and how they have come out of it. I am a pure believer in looking at the data from behind and seeing how it applies to us moving forward. And Larry's going to help us interpret that today. So let's look at what's happened so far. The two black marks there are both the high of the year and the low of the year. So this is $1 invested at the beginning of the year. And what happened? It went up to a high of 102. And now it's down to a little over 71. And this is just the equity markets. And they have experienced increased volatility, as you can see here. Now that's in stark contrast to the steady growth that we often expect and actually have had much of the last 11 years since the last crisis. So this plots how a dollar has reacted invested in the world stock markets over the last year. Now let's take a look at other crises. So we're already in this one, right? Markets have reacted. Prices have reflected the new situation, the new amount of data that we have within the marketplace. It is amazing, being a former trader, it is amazing how quickly markets react. But what this is kind of looking out the rearview mirror and looking at what has happened in other crises prior to this. So with our years of experience, we know that a disciplined investor looks beyond the concerns of today. That's not easy to do, but it's what you should be doing. And you should look out over the long-term growth potential of markets. So this slide shows the performance of a balanced investment strategy following other previous historic crises. And these are just a few of them. Although a global investment strategy would have suffered losses just like the strategies did through this one, it's important to know that they recovered and they actually had returns over the period afterwards. In here, you can look at the bottom. It delineates across here, 7 different crises. It shows the 1 year, the 3 year, and the 5 year annualized returns of what markets did afterwards. So once markets react and reprice, they then recover and they go up. Negative events such as these may tempt investors to jump ship, to flee financial markets. But diversification and a long-term perspective can help investors like you, myself, and Larry apply the discipline to ride out the storm. So let's look at a history of market up and downs. This is the S&P 500, the largest corporations in America that experienced a 20% downturn. So we have exceeded that now. So we are now in bear market territory. Bear market is when from the high to where the market is now has breached 20%. This chart shows that we can see from the chart that in good times, markets have been disproportionately longer than bad times. So we can expect positive returns every day. Believe it or not, you can expect that right now, even in the middle of the crisis. But while there is no consistent way to predict when performance will be positive or negative, investors staying the course, sitting in their seats, staying invested, have been rewarded over a long period of time. So let's talk about briefly what you and I and others are going through emotionally. Some of us suffer from this more so than others. The idea to investing is to buy low, hold on to it, and sell when it's higher. Yet, following an emotional investment cycle sparked by reactive decisions may bring the opposite effect. So as you go through this cycle, and we all know this can be both in markets, it can be in your personal situation. There are so many things that can affect how, as an investor, you look at this cycle. But you'll see that it can offer the opposite. So optimism happens, people invest, it starts to get elated, they pile in further. Oh, it's doubled, it's tripled, it must still be going up. And then unfortunately, sometimes markets turn over right as people have the highest level of exuberance, which is maybe why it was high. And then it starts to turn. And then investors turn and they start to get nervous. Did I make a mistake? They start to have regret. Go through all of the behavioral biases that many of us have succumbed to in the past. And then you get down into the fear range. I'm not saying that's us now, that we're in the fear range, but I'll bet you there are some people out there that are getting close. The severity and the swiftness of the volatility is intimidating. But when they get down, they might actually bail at the bottom, somewhere near the bottom, and they might just throw their whole investment plan away. They've locked in their losses, and they're going to experience the stress of when eventually we come out of this, which we will. They will have the stress of watching it go back up and then having to make the decision, when is it safe to get back in? And as my friend Larry Swedroe, who's about to speak to us, says, it's not like going to the beach and swimming. They don't put up a green flag and say, yeah, everything's safe, the water's good, come on in. There's almost always a yellow flag out there. There's almost never a day that says there are no stresses or things that could affect your investments. But staying disciplined in rising or falling markets can really pose a challenge, but it can increase your long-term success. And there is so much data to back this up. One more slide here. This chart reports the performance of markets subsequent to a 10% decline, which we have exceeded. Again, the S&P 500 through the end of last year. But you can see that once it exceeds the 10%, then going forward, these are returns that you can expect on average, looking backwards, not you can expect necessarily, but that we can look back and we can say if we aggregate all of the 10% declines, markets do stabilize and do recover over time. There is hope that you can get this. And remember, this goes back to 1926, which was prior to the very long period of depression by which we had multiple up and down times. So let's talk. I mentioned a minute ago about staying in your seat. What if you don't? What happens if you do decide you can't take it anymore? You have too much risk. Maybe you're just really scared because you've had neighbors, friends, coworkers that have come down with the coronavirus. I don't know what it might be. Maybe you don't have a large enough reserve fund. Maybe there's other things that are happening within your life that's really stressful and you bail. So this is looking back over the 30-year period between 1990 and 2019. During that period, there was just shy of 8,000 trading days, days that the exchanges were open. If you look at those days, now remember, out of somewhere close to 8,000 days, if you look over to the right, the fourth one, it says miss the 15 best single days. Just 15 days out of that whole period, 30 years, would have cost you to lose 34% of the annualized return during that 30-year period. Can you imagine 15 days equating to maybe you having to work longer, not being able to take care of your family, maybe not being able to leave a legacy for your children? That's quite intimidating. But had you sat in your seat, had you actually not jumped out, your total return for the US stock market for that 30 years would have been 10%, just shy of it. How great is that, that you can get an annualized rate of return of 10% over a 30-year period in spite of all the crises? And soon I'm going to show you a chart that's actually going to show you many of the crises you may have already forgotten about. Here it is. This is basically just some of the things that we as investors have experienced going back to 1970. As you can see, there were so many different things that had happened, including Black Monday, which happened in 1987, which was a 23.5% drop of the S&P 500. The US stock market lost nearly a quarter of its value in one day. You want to talk about strain and stress on investors? That day was big. But you know what? That year, we actually finished up positive. So I'm not trying to tell you that markets aren't volatile. I won't tell you that things reprice, but what I will tell you is that you can see from this, and we have charts that go back past way longer than this, that there are always things that happen. There are always crises that we have to survive and thrive through. And the best thing to do is be a disciplined investor, to look beyond the concerns of today and take that long-term outlook in order to survive and thrive. It's not easy. It tests you. But I believe if you have a good advisor, if you have a solid investment plan, those things are attainable. I've been investing in this way myself personally since 2000. I took a personal loss because I owned a bond fund where the manager went off the prospectus and bought some very illiquid bonds. And in one night, I came home and my safe reserve capital went down by 44%. Can you imagine? I was a professional trader, someone with expertise on trading financial futures. And here I come home and my safe and secure money drops 44%. It was not a good feeling. But guess what? It took us 7 years to get through that. I was the lead plaintiff and we survived and thrived. I still built my business. I still raised my 2 children we had. My wife was pregnant, by the way, during that period. And it was pretty harrowing, but we got through it. I got the right lawyers. I became lead plaintiff and we had great recovery. So now, Larry, I'm going to leave this up for you if that's okay, or maybe I'll stop sharing my screen and we'll bring you and me up.
Now, Michael, if you would just go to slide 9, I wanted to make one other comment that I think is very helpful since you had that slide up.
Wonderful. Larry,
The
Would you
one
tell me
with the
when you
best days. So you're going to go back one more. Go back, yeah, one more, I
oh,
think.
that
Yeah. So here's something that's helpful for people who are thinking about maybe I'll just get out for now. I'll wait till things calm down. So a study was done on 100 years of the stock market returns. And if you took out the best 100 months of the 100 years, not the best month of each year, but the best 100 months, this is a period where the stock market returned 10%. If you miss those best 100 months or 8.5% of all of the months, your return would have been zero. So that's why it's so important to have a well thought out plan, as Michael said, that allows you to stay the course, not taking more risk than, as we like to say, ability, willingness, and need to take. Because if you get out, you just might miss those periods where markets skyrocket, which typically happen, by the way, right after the worst bear markets are occurring. So thank you, Michael. What I want to do here is to provide some background about what's going on, how deep this crisis might get, some perspectives from history, and to tell you, by answering some important questions, why do the markets seem to be acting so wildly many times when there's no more bad news even, and you would think, for example, we just got massive Federal Reserve action, the big fiscal guns have been pulled out, not only here and overseas. Why aren't the markets reacting? And it's hard to know, but I'm going to try to touch on that as well. So first thing I want to touch on, as Michael noted, is that volatility before this crisis began was at pretty much historic lows. The VIX index, which is a measure of volatility, was trading even under 14 as we were around Valentine's Day before this picked up. And just as an indication of how high volatility went, the first 4 days of this week, and I'm guessing today is another day like that, we exceeded volatility of 80% every single day. So volatility has gone up basically 6 times in that 1 month period, and we have been just short of the single most volatile days in history, which occurred at the worst point in 08-09. So these are definitely extraordinary times. We've also experienced a record drop from a historic high, which we again achieved in the middle of February, to a 30% drop. This is the first time we've ever seen a drop like that big, that quick in 30 days. This is why there's so much stress and why people are so nervous and scared. We literally have never seen anything like this in the history of the market. Even in the Great Depression, we didn't get this quick a drop this quickly, at least to my knowledge. So let's consider, with that in mind, take the view, how bad are the markets really expecting earnings to be? So historically, bear markets occur due to cyclical changes in the economy, like Federal Reserve comes in to raise interest rates to slow the economy down. We're overheating and we want to protect against excessive inflation. Or we might have a structural change in the economy like we had in 2008 that went on. In those bear markets, which are the vast majority of the time we get a bear market, earnings have typically dropped in the 40 to 60% range, and in the worst cases like the Great Depression, about 80%. But the typical is 40 to 60, and it typically takes an average of 3 to 4 years for earnings to fully recover. Sometimes it's a bit longer, but that's the average. Let me give you an example that's relevant. We peaked in earnings in 2006 before the last crisis. Earnings were at $88 for the S&P. They dropped slightly in '07 as we started to enter this bad period late in the year, and the S&P earned 83. By '08, they had fallen to 50. But by 2010, they were again 84, and 2011, we were setting a new record at 96. So basically, that worst recession since the Great Depression fit right in with that period where earnings were dropping about that 40, 50, 60%, and we got a recovery in that 4 to 5 years. But it's important to understand that we also get event-driven earnings drops and causing markets crashes. But they tend on average to see earnings drop just as badly, but they recover much more quickly, again on average. So in a good example, a 911, we look at 2000 earnings, they were 56. And by 2001, they had dropped all the way to 39. But by '03, just 2 years later, we were right back around that 56 level. On average, event-driven markets like that, we get a recovery, surprisingly, perhaps on average, in about 1 year. Now, nobody knows whether this one will be that V-shaped recovery or maybe a U-shaped recovery, or hopefully not even an L-shaped recovery, because none of us has a clear crystal ball. And by the way, while I'll divert for just a second, this is a really important lesson. And what I'm going to tell you now relates not just to investing, but forecasting in general about anything. The science of investing and the research shows that the more confident people are in their forecast. So they'll give you a forecast. The S&P is going to go to 666, like that, and they say it with certainty. Those are the people who you really need to ignore because they don't know what they don't know. The smartest people think in probabilities at best, and they think about dispersion of potential outcomes because they know the world is uncertain. And when you hear people talk in probabilities, then you know the odds are good. You'll think you're listening, reading, or watching someone who's intelligent, and maybe you ought to pay attention. If you're hearing the first kind, I would urge you to stop reading, stop listening, shut off CNBC or whatever, because it's likely to do you harm, especially if their views, their fears, whatever, agree with your preconceived notions of fears. That's called confirmation bias, where we put great emphasis on opinions that agree with our own, and we think they're really smart people. And when they say something that disagrees, we get what's called cognitive dissonance, and we say, oh, they're dumb, and you just ignore it. So it's important to understand, again, listen to people who talk about dispersion of possible outcomes, think in odds, like what are the odds of drawing to that inside straight in poker. All right, so how is the market expecting corporate earnings to look? Okay, what is it saying about this drop? And there is actually a way for us to estimate that by looking at what are called dividend strips. So just like you can strip out the interest payments on a treasury bond and buy only the principal payment or only the interest payment, you can strip out dividends, which turns out it's a good proxy, not an exact, but a good proxy for then expected earnings growth. And here's what the latest data shows. What the market is expecting, this is going to be a pretty severe drop, earnings down in that 40% range, which is in that average drop, but it's actually forecasting that the bottom will not be reached for 3 full years till the end of 2022, which would be extraordinary. And it is not forecasting a full recovery till the end of the decade. That's 10 full years, when I've told you The average for the other types of recessions is about 4 to 5 years, and the average for events is like 1. So this looks to me more like people, it's a panic selling rather than rational selling. And panic is a natural reaction when we've never experienced anything like we're seeing now, this global pandemic with a virus that nobody knows how at the moment to cure. Although I'm going to touch on that, Michael. If we come to the end, we'll talk a little bit. I have some insights that many of you probably haven't heard on the medical front, which are all good, I think. I've had access to some of the top medical experts in the world over the last week, so I can share those with you as well. Hopefully we'll have time to touch on that. So this 10-year really bad period, I have to say, is certainly a possibility, but it doesn't seem likely. And it looks like markets have crashed beyond logic. So how do we understand then how we as individuals think about investing, and why is this happening then? And the important thing here is to understand what we would call the difference between risk and uncertainty. And what do I mean by that? You can think of risk in the following way. When you're sitting at the poker table, we know, if you're a good card counter, what are the odds of drawing that flush or the inside straight? You can calculate it exactly. An insurance company can estimate pretty well, if you're a 35-year-old male and you're healthy, what are the odds you're going to live at least till age 65? It's not perfect, but we have lots of history there. So that's what I mean by risk, where we know the odds or can really have a good estimate of them. Uncertainty is where the very best we can do is to estimate the odds. And in many cases, we can't do that. So what are the odds that we would have had a 911, right? That's the kind of thing we mean about uncertainty. Now, if you think about it and ask yourself this question, would you rather make a bet where you know the odds or one where you can't even estimate them? Clearly, we would prefer the former, especially since human beings tend to be, on average, highly risk averse. And investing, when things are going well, we tend to think about investing in terms of risk. But when things like this happen, or a war in Iraq, or an earthquake shakes the Japanese nuclear plant, and who knows what that was going to set off. Those kinds of things cause people's fear to jump, and then they apply a much greater discount to future earnings because the uncertainty level is rising and they fear uncertainty more than risk. So what you're getting here, and this is important to understand, is people are saying, one, earnings are going to drop 40%. That sounds reasonable based on history and what forecasts we're getting out of economists, although they're changing by the day. So the numerator in an equation, there's your cash flow, is your earnings in the numerator, that's dropping, but the denominator is the discount rate you apply, your risk premium, that's going up at the same time, and that's how you get these kinds of crashes there. So the market can drop much more than the economy is likely to drop. And now you get this problem of a vicious circle happening where prices on any day can really collapse when there's no news and people wondering what's going on. Today, you might consider one of those days. The market was up 700 or so at one point, I believe, overnight. This morning, it went down to about flat, was up about 500, ended up, I think, down 900. Why is that happening when, we're getting, I would say, more good news on a bunch of fronts? So here's the process that happens that has nothing to do with the economic news necessarily. So what we get is the following. Most investors are prepared for what are called corrections. We get that, which is a 10% drop. literally on average 1 month, one cycle in every year. We get at least a 10% drop in most years. That may surprise people, but that's true. So most people are inured to that. They don't panic and sell. But when you get beyond that, maybe to 15%, you get a cohort of investors who reach what I call their GMO point, a really technical term, which means their stomach is screaming, "Get me out." And they can't take it, they can't sleep, and so they panic and sell. And that cohort of investors pushes prices down, and then another cohort of investors hits their GMO point. And then you get the second part of the cycle happening, which is aggressive investors who are borrowing on margin, and then they get a margin call because the market has dropped, say, 20%, and that's the limit. And then they can't put up the extra collateral. So they get a margin call and they must sell, or the broker will liquidate the account for them. So that pushes prices further down in already likely illiquid markets where there aren't a lot of buyers who are waiting to see where this bottom might be. And now another cohort hits their GMO point. And then you get, and I know some of you are traders, have been in your careers, Michael's, you get the trend followers, the CTAs, the momentum players. They all entered this year with long positions in equities. And so I'm just going to give you an example. Fund might have been $100 million long equity in a managed futures fund, and they're long right up to February 14th. The market starts to go down, and maybe by the 2 weeks later, their signals have turned and they get out. They don't just sell 100 million. They sell 100 million to get out of the long, and then they sell another 100 million to go short to ride that trend. And you get markets collapsing from there. But we're not even at the end of that cycle here, unfortunately, because you have investors who are what are called value at risk investors. You may be familiar with the term risk parity. They build diversified portfolios across stocks, bonds, commodities, and other investments, and they try to keep a constant volatility for their portfolio. So this may get a little technical, but I hope you'll be able to follow. I'll try to make it as simple as possible. But it is an important concept to understand why what is going on is happening. So if you own a balanced portfolio and you own stocks, stocks historically have a volatility of about 20. Okay, so if you have 20% of your investment in stocks, you could take 20 times the volatility of 20 and you get 400 risk points. If you have safe short-term bonds, they may have a volatility of say 4, and you've got 20% there. So you say 20 times 4, that's 80. And then you do this and you have a risk budget, okay? Well, when volatility going down, which is what happened when markets are good, and I mentioned the VIX was at 15, they now are saying, hey, my equities, which are 20%, instead of being times 20, give me 400 risk points, which is what I need to stay stable. They multiply that now only by 14. Oops, I got to buy more equity. So as the markets were going up, they're buying more and contributing to the upside. But now you get these spikes up and the VIX doubles to 30, and they have to cut their position in half, and then it doubled again to 60, and they have to cut it in half again, and then it goes to 80, and they're cutting their positions again. And the same thing is true with these risk parity traders. There are 175 billion or so of assets in these funds. Now that's not a huge amount in in the big scheme of things when there's so much daily trading, but when they're piling on, they could contribute. Michael, you wanted to ask a question?
Yeah, Larry, I just hear in your synopsis here is that there's a long history that we should know, that there are some technical things that are important and how in crises that data stream, and I mean, it changes, right? Yeah. And certain institutional players and other or it might just be mom and pop at home, just in that GMO point, they kind of pile on. And I think that's why we see that rubber band dropping so fast sometimes in markets like this, right?
Yeah, that's exactly right, Michael.
But Larry, let's back it up just a little bit and let's think about what is the investor thinking today? Because some people that you and I both know are those momentum players, those risk parity people, but they're also investors just like you and I are with our own portfolios. So can we bring it back a little bit to what questions maybe somebody that's an investor that doesn't have that astute knowledge that you do about all these different things that come into play during markets, what should they be thinking about? What actions can they take now that we've seen the move? And frankly, you can't do anything about it. It's already happened.
Right. So let me add just one more point because I want to make sure everyone understands how these things happen.
Thank you.
Which is you have another group of investors. The banks after '08 call up my good friend Michael and say, Michael, I know you want to be in stocks, but you're scared. You saw what happened. We've created this great new product. You can earn up to 10% if the market goes up, but you're capped out there. But in return, we'll cap your losses at 10%. Those are very bad products with high expenses. But here's and no one should buy them, by the way. But here's what happens, because I will tell you that tens of billions of dollars were bought despite the fact that these are egregious, excessive fee products. But people don't understand the math, so they're sold. But if I'm XYZ Bank and I've sold that, everything's going fine right up until around February 20th. And now I'm protecting Michael, who's bought this, and I'm short this put. The stock market's crashing. I've got to go out and sell S&P 500 futures to protect my downside. So now you got them. So you have the GMO points, you got the margin calls, you got the momentum traders, value at risk, and these structured products. So now what you need to understand, and to answer Michael's question, markets can crash much more than the economic news really justifies. And that's why I started out by explaining we do think earnings could drop 40%. That's baked in. That's what the market is expecting. We don't know if it's going to be better or worse, but that's the market's consensus forecast. But prices are dropping as if the market isn't going to recover for that, for not even bottom out for 3 years and not even hit a new peak for 10, when I've told you the average in events like this has been 1 year. There have been worse cases, of course, but and the other markets all tend to recover from crashes an average of 4 to 5. So it's telling you that this is likely an overreaction. We know markets overshoot, both on the upside like it did in 2000, and now on the downside, and also in '08. Let me add one other point, Michael, that's really important. Markets recover much faster and before the economy does. So we recovered on March 9th of '09. The stock market began a rally. The economy didn't end the recession until officially July. That's 4 months later, but that wasn't announced till many months later. And unemployment was still rising right through the end of the year. So 9 more months. So if you're waiting for the signal, okay, unemployment is peaked, right? If that's your signal, you're 9 months late and missed a big part of the rally.
So Larry, that would go back to the 15 days or whatever it might be that we showed that, you possibly might be able to, we are in a correction phase. Markets do start to go back up. They don't turn blue till they recover and come back, right? But what they do is they start before we know they're going to come. So even though you're still in this emotional, distress, because maybe your company is having issues. Maybe you have family members that are still suffering. I'm not even talking about the medical. I'm talking about just the financial. Maybe you're still in the doldrums, but maybe markets have already started to look out and price that in. And if you actually bail, you might actually be suffering from what's going to happen here, that the markets turn around and you're actually going to miss those gains.
Yes.
I'm not saying that's going to happen tomorrow, within a month, with 2 months. I really don't know. neither you or I have a crystal ball, correct?
Right. That's exactly. Let me give some good things for people to be thinking about, to have optimism, because I think that's important
Well, it's about
to be
time,
able to
Larry. We
see
all
through
been
this.
waiting. Thank you. Go ahead.
Yeah. So first of all, this is not like '08, which was a great financial crisis, and the worst crises that take the longest to recover from are when the banking system gets slaughtered, because banks can't lend and then everything shuts down. So the two worst recessions were, of course, the Great Depression and the one in '08, and they were caused by banks and their weakness. Today, banks are literally, and by far, it's not even close, the strongest financial position they've ever been in, with their capital ratios more than double where they were before we entered '07. Bank capital ratios are now at almost 12%. So that's really key. Second thing I would say is the Federal Reserve has learned some great lessons, painful as they may be, from the '08. So they took a long time to provide the liquidity to grease the wheels of the economy and step in, help the banks. Lehman failed and other things. The commercial paper market shut down. Money markets were threatened. They have already fully engaged there, providing over $1 trillion of liquidity. I would fully expect, likely, they may guarantee all bank deposits, money market accounts, but they're providing literally unlimited liquidity to banks, and they now have approval to lend to industries like the airlines and autos. On top of that, the governments have learned. The U.S. was the first government to really act quickly and get a fiscal response and also a monetary response. That's why we recovered much faster than Europe. We didn't wait at all now. Now we're going to pass $1.5 trillion, stimulus plan that's more targeted. So we've learned from that. And let me add this one other thing. I think everybody here has faith in our democracy and capitalist system, or they wouldn't be invested at all. You shouldn't be in stocks. So if you think about it, we're at literally zero or negative yields on any safe bonds after inflation. Stock PE ratios are now much lower than they were just a month or two ago. So the expected real return to stocks, which we estimate by taking the inverse of the price earnings ratio, is 5% real return for US stocks, 7% for European and other developed, and 9% now for emerging markets because they have much lower valuations. Compare that today to the less than 1% yield, say, on even a 10-year treasury, which means after inflation expected of, for argument's sake, 2%, you have a minus 1% return. So once markets calm down and this wave of panic selling ends and we can see the light at the end of the tunnel, and none of us knows when that will be, stocks are going to look, I think, awfully attractive, but it doesn't mean they can't get cheaper in the short term because you can get these waves of selling, Michael.
Well, thank you for that, Larry. Larry, I'm going to jump in here for 1 minute. We are really respectful of everybody's time, and thank you so much for joining us. One thing we like to do is educate, and we're going to have some of these these WebExes going on further, and so we'd love you to join us. I'm just going to show, in case people have to jump off to handle something at home or get on something on a call, this is what we're going to offer at the end. The first thing is I wrote a blog piece on the 20 steps to prepare for a recession now, and I just made a video around it. We're going to share that in our follow-up email. The other thing we would like you to do is either in the chat section here or just reply to the follow-up. We are going to offer to you free a copy of the successful guide, the guide to a successful and secure retirement. I think it's a phenomenal book. Not only does it have Larry's input, but it also has input of a bunch of different experts on the various things, whether it's retirement, Social Security, Medicare, so many other types of insurance products and other things. It's really a great book. Larry, I commend you and Kevin Grogan for all the efforts that you put into it. I actually am blessed that you allowed me to write a foreword for the book, so thank you. But we'll share that with anybody that sends us their name and address. If you're not a Cogent client already, we'd be happy to share that with you. The other thing we'll do is we're going to offer you a confidence builder. It's a free, no obligation second opinion service of what you own, how you own it, and the risk you're taking. We'll have a conversation to see where you're at and where you're going. And then we'll compare what your investments are and see if they match that. And we'll be happy to do that for anybody that sends it our way. And the last thing is, if you don't work with a fee-only independent financial advisor that acts as a fiduciary, I'm not talking about a Merrill Lynch or a Morgan Stanley or a bank person. I'm talking about an independent registered investment advisory firm like Cogent. If you don't work with somebody like that, please reach out to us. We're happy to take your calls. We'll be happy to talk to you and help you out. You can go to our website, cogentsw.com, for help. So thank you for that. So Larry, let's talk a little bit about what an investor can do today. I'm just going to put up this screen really quickly while you do that so people can listen to you and also learn that downturns are not unusual. This shows right here in the average year. I'm not talking about a year when you have coronavirus or the capital markets falling down like they did 08, 09 or the dot-com bubble. The average year peak to trough is 15.5%. Larry, what can an investor do today? They find themselves in this position. Would you tell us a couple of things that would be prudent for an investor?
Yeah, if you'll notice, of course, Michael, all those blue dots, you can see how, as I mentioned, almost every year has a loss of at least 10% at some point during that period. And you see many significant drops. We've seen now, this is the fourth drop of 30% or more in the last 47 years or so. So we get one about every, now you could say 12 years or so. So the key is you must build that almost certainty into your plan. And that means if you're, say, 65, you better expect another 2 or 3 of them over the rest of your life. So your plan must include the virtual certainty we're going to experience this period like this. So that means you don't want to take more risk than the words we use, and we describe what we mean by that in detail in the book. Your ability, willingness, and importantly, need to take risks, meaning if you won the game already, why are you taking more risk? Because the upside benefit is likely not going to change your life in any meaningful way, but the downside can be awful and tough to live through. So you want to make sure your plan is right, and if you're not confident of that, then you ought to be talking with Michael, and he'll help you figure that out. But we run those tests to make sure that your plans can survive that, running what are called Monte Carlo simulations. So if you haven't gone through that exercise, I would urge you to do so. I would add one last comment. Living through observing back tests like this and seeing those big drops in the down arrows is much easier than living through them like we are today. So it's really important to not lie to yourself or be overconfident. We see too many times people say, yeah, I can live through a 40 or 50% drop. Then when it happens, they panic and sell, and by then it's too late. You've locked in that loss, where if you were more straight with yourself, you would have prevented that bigger loss in the first place. And then you can't recover because you've sold out. So it's really key to get those things right, Michael. And this is a great time to review your plan to make sure it's a good one, and also that you have this plan B, which might include, hey, well, I'm going to just cut my travel this year. I'm going to maybe move. I was thinking about moving to Florida and selling one of my home on Lake Michigan and get a little cheaper. You could do those kinds of things. Whatever your plan is, that's what you want to have ready, because battles are won in the preparation stage, not on the battlefield.
Yeah, I agree. And I also love to talk about a reserve fund. I think it's really important, and all of our clients hold them, is to have 6 months to a year, depending on your own situation, sometimes even longer. I have a family that's counting on me. I own a business. I have employees and clients. I have more than that actually in my reserve fund in an FDIC insured account. And frankly, right now I'm going to get no interest, but that's fine. That is going to allow me to be able to ride through and my family be able to survive and actually probably thrive through whatever's coming, hopefully, no matter how long in that. So we love reserve funds, and that may mean you have to do a little bit of selling if you're undercapitalized in your reserve fund to be able to move that over. And there's ways to do that that can actually be beneficial for a tax-wise. You can actually take some losses maybe and harvest some losses that you could use on your taxes. So Larry, you see investors coming into this. Would this be the time to just say, I've reached my GMO? And if it is that time for certain investors, what can they do to maybe mitigate that? What steps can they take now to maybe say, okay, I'm not going all out, but I'm going to take a little bit?
Yeah, so the first thing is to understand is we are human beings. We make mistakes. Overconfidence is one I consider an all too human trait. So you don't want to beat yourself up too much if you recognize I made a mistake. It's better to admit it and prevent it from happening again. And you'll have to take a loss because you should be reducing your equity exposure. Now, the good news in one sense is if you want to be reducing risk, the market has already done that for you because your equity allocation is down. And let's say you were 50-50 and now you're down to 42%, and you should be rebalancing. But if we were to do that for you, it might cause you to lose so much sleep because, oh my God, it's going to get worse. What I would urge, if you have learned you've made a mistake, have your advisor, Michael, can run a new Monte Carlo. If you can survive at a 42% level, I would say that should be a permanent change and live with that era, but you don't want to panic and sell here. If you find maybe it needs to be 40, run the numbers, do that. Now, one other thing I would add, Michael.
So Larry, let me interject for some people that don't have the benefit as your and my clients do, that have the ability. So what you're saying by run the numbers, it's use a very sophisticated but robust financial planning and program like Kelly Stanley within our organization is very adept at. Put in the inputs that you have. So what assets you have and where, how much you're going to need to spend and for how long, and then run those numbers and then see no matter what the dispersion, and you talked about that earlier, of market returns are, how do you come out through those dispersions, right? What confidence do you have that you can not only survive but thrive through that? Is that what you mean?
It's exactly what you mean, because a big mistake that many people make, Michael, as you know, they think about returns in a deterministic way. Stocks are going to get 7%, let's say, going forward. But you and I know if you're unlucky and it's Japan, 1990, the next 30 years are actually a negative return now. 30 years negative return. And that's even before inflation. So you have to consider that. You could get lucky. It's 1980. The next 20 years are the best market virtually ever. So we don't know which it will be. So it's important that you look at alternative universes, to use that Star Trek term, and make sure your plan can live through any one of them.
So Larry, what about this? Let's be a little more optimistic. I appreciate you talking about Japan and that, but the antidote to that would be obviously diversification, right? That you would want to own the entire market throughout the world and not just one country and have that bias that maybe the Japanese had going into that because things look so good. But let me be a little optimistic now. Say you feel good about your job prospects. You worked from home anyways. I mean, I have an office behind me right here at home that I meet with clients or I do virtuals with them anyways. What if you did have a reserve fund and something in place? So your job was strong, you did have that, but you found yourself to just have received your bonus. And you really think you have everything tucked up the way it should be, Larry. What happens if you had some additional capital? How would you think that maybe that should be either put to work, or what are your feelings on that?
Yeah, so one thing, normally we would say whenever you have cash, that's a good time to invest it, because there's always an equity risk premium, which means we expect stocks to outperform bonds regardless of the maturity of time frame. We should expect that. So that's the simple answer to that question. But we are not in normal times here. we are in extraordinary times. And we also know, and Michael, you know this well as a trader, that there is evidence of this time series or trend momentum. So things that are tending to go up continue to, on average, go up for a little while longer, and things that are trending down tend on average to also continue to go down. So in this time like this, discretion might be the better part of valor. There's no certainty, no system works, but the odds do favor slightly patience. So I would encourage people, because we don't know what will happen, and we know markets can also recover very quickly, to maybe take a dollar cost averaging type of approach. So if you had new cash, you might say, let's take 1/5 of it and put it in now. Let's watch 2 weeks or a month. If the markets have begun a recovery, then great. And we missed the bottom, but that's okay. We got a nice profit. On the other hand, if markets do continue to drop, at least you feel good that you didn't just jump whole hog in, when in hindsight it will look like it was obvious it will go down. Whatever is going to make you the most comfortable and enable you to sleep well is the strategy that I would follow. But the odds, I would say, particularly because of this, vicious circle problem, do favor slightly patience and maybe just dipping your toe in the water and not trying to pick that bottom.
Great. Right. Thank you for that, Larry. I'm sure there's a lot of people that are inside optimistic and also scared at the same time. So I like that balanced approach. And we actually I spoke to a good friend and also a client today. That's very in keeping with we gave to them. So we're coming up on the time to finish this up. Larry, can I just ask you now, before we're not signing off yet, but could we do this again? Would you be good enough to be able to join us again and talk about things once we see it play out a little more?
Sure, Michael. I'd be happy to do that. We can schedule that. And I don't know if you have time, but we could touch on those few key medical points I mentioned. That's up to you.
Sure. Right. And then at the end, I'm going to wrap it up. And we might go just a couple minutes longer. Larry is in charge now. So Larry, give us what you learned.
All right, just real quick, because I know everybody's hearing these things in the media, but I learned some things I thought would be of interest for the group. So the first is that while this trajectory of the virus infection is skyrocketing now in the West, especially Italy and France, and now the US, very different in Asia. Japan, virtually a flat line now. And that's because they have experiences with viruses like SARS, and they began the social distancing almost immediately. And so we have lessons which tells us that now that we've engaged these dramatic actions, it's likely to flatten out, but it's going to take maybe a month for that really to happen. So that's important to understand. We see this already around the world. Second thing is SARS was very different and less dangerous in one sense, because once you got the symptoms, that's when you were able to transfer the virus to somebody else. This case, with this virus, the symptoms don't show up and you're still able to transfer it a day or so before you start to feel badly. So that's why you could spread more quickly. Second point, 95% of all the infections around the world have occurred north of the 22nd and a half latitude, and that's half the world population. 5% of the rest of the infections occur in the other half of the globe. So you could think about in terms of temperatures, where temperatures are above about 40 degrees, there's almost no of this spreading of this virus, which might tell us, no certainty, that hope comes when weather warms up. Third point for people, 85% of infections are family clustered. So be aware of that. 97% of the infectionness of the virus is gone within 8 hours of touching a surface. So you don't have to worry about the shipment from Amazon that left the warehouse 2 days ago. Or, by the time you've got it, it's perfectly fine. You don't have to worry about that.
1 minute, Larry.
Yep. The last key point is this hydrochloroquine combined with the Z-Pack was in a test in France, 40 people control test, 100% cure rate at the end of 6 days. Now it's a small test, but this is now going to expand rapidly in other places. And there's also one other drug, remdesivir, which is by Gilead, which is also being tested. They can't prevent the disease, but they prevent the virus from replicating itself, and it quickly dies out. So there's good news. I thought that one was really important for people to hear. That also could give you hope for even if we get sick, we now know, seems likely, we have a remedy.
Well, that's outstanding. That's outstanding. Larry, this might be completely inappropriate, but have you heard any good stories? Are there anything that you've listened? I'm hearing from friends, both. I talk to clients every day. Nobody's jumping off the ledge yet, but everybody's asking about my family and how my children are doing. I have everybody home right now. I feel really blessed in a way. But Larry, tell me, is there any good stories you've heard before I wrap us up?
Yeah, well, the best one, and we can all use a little humor in times like this, is my wife was walking with her good friend, and her friend told her that she had called her daughter that prior night and asked her how the first day of homeschooling went with her 3 children. And she said, "Mom, so far so good. First day, 3 students suspended, teacher on probation for drinking on the job."
Oh, that's crazy. That is crazy. So Larry, let me wrap this up a little bit here. And thank you everybody for allowing us to go over just a few minutes. But as you can see, we've gone through other markets downturns because of epidemic. SARS, Spanish flu, MERS, Hong Kong flu, other epidemics. So what we have learned is that they do hit. We actually had one in 09, that hit through 09 and 10 while we were going through our own economic crisis. And we've recovered from that, as we saw. So there is hope that these things do happen and they pass. The other thing is that over long periods of time, here's going back to 1926, capital markets have returned returns to investors. It is never a straight line, and to think it is really detrimental. So you have to have a plan, you have to have very good reserves, and you have to be able to stick it out. But now let's talk about where we're at today and what we can help with you. All I'm going to say is I think life is uncertain anyways. These markets are just one of the many things that we as individuals are up against in our life. That they're also unpredictable. And that's hard. That's really hard to deal with. But even those emotions, and while they're running high that you have, because you have those emotions, you don't have to take knee-jerk reaction with your wealth. We have shown you today that they actually do recover over time and that there is hope for the long term. So Larry and I will tell you that our experience is these things happen. This is a normal part of investing. It's just extremely uncomfortable. But economies work, capitalism does prevail, and that is all part of investing. We don't know how, we don't know when it's going to end, we don't know how long, but the markets are going to correct. The evidence shows that they will rebound and there'll be strength again. So now is the time to work with your advisor. Stick with your plan and see it through to the other side. If you're unsure what works for you, we're going to offer this free portfolio examination. I'll be willing to do that to you. Send us an email, reply to what we've given you, and we're going to send out the 20 steps to prepare for a recession now. We're offering you a book, Larry's book. We'll be happy to mail you out a copy on that. It's excellent, really good tone, really good. It's kind of like the manual for money, I would say. And then we'll also be able to have a conversation with you if you want in a second opinion service. So know that you're not an island. No one's in this alone. We're all in this together. Everyone is suffering equally, just at different places. Let's all thank God that we all have good families, that we all have the ability to probably survive through this and also maybe even thrive someday, way looking forward. Larry, I thank you for your time. I thank everybody that joined us today. Really appreciate it. and let us know how we can help.